10 million rupees, 1 crore. For most people staring down their financial future, looking at a number that large carries an immense psychological weight. We are conditioned to believe a portfolio of that size requires a massive monthly paycheck, or a sudden inheritance, or maybe relying on a risky, short-term gamble in the markets. But building wealth over a span of decades is entirely indifferent to luck. It actually operates on a cold, mechanical set of rules. If you break it down, accumulating a crore relies on a basic formula. Exactly 4 variables working together to systematically construct a portfolio from the ground up. The first step to actually reaching that goal is abandoning the hope for a magical miracle and accepting the strict, repetitive discipline of this math. We start with the first 2 pillars of the equation: the total duration of your investment window and the consistency of your monthly contributions. This animated timeline maps out a standard 30-year chronological window, tracking an investor from age 25 to 55. If you deposit a fixed amount every month, you slowly stack up your raw principal year after year across the timeline. Because you are stretching these deposits across 3 entire decades, the math is forgiving. A longer horizon means you can reach your target without needing to lock away massive portions of your monthly income. But if you delay this process by even 5 years, starting at age 30 instead of 25, the required monthly capital to reach the exact same target drastically increases. Time is the heaviest, least forgiving variable. For individuals with an average income, maximizing your years in the market is mathematically non-negotiable. This brings us to the fourth and most aggressive variable, compounding. This is the simple mechanic of your previous earnings generating their own separate earnings. Look at this graph testing an illustrative 12% return. A 10,000 rupee monthly investment makes a slow climb. Doubling it to 20,000 accelerates progress midterm. But a 30,000 input hooks upward aggressively, intersecting the 1 crore target at 30 years. Notice the visual gap between these paths. In the first few years, the lines are nearly identical. But as we move into the second and third decades, the distance between them stretches significantly. This divergence happens because compounding is heavily backloaded. It uses the first 10 years to build mass, but does the vast majority of its exponential scaling in the final decade. Your regular monthly investments dictate the size of your foundation. Compounding acts as the exponential multiplier that ultimately bends your trajectory upward to cross that millionaire threshold. A clear goal, maximum time, regular monthly inputs, and the force of compounding. That is the complete equation. Understanding the math is easy. The actual challenge is executing it. It requires maintaining psychological discipline month after month, over thousands of days, regardless of market conditions. This formula only functions if the capital is deployed into an asset capable of generating those compounding returns. Cash held in a standard savings account will not trigger this curve. So where do you actually deploy this capital? Maybe fixed deposits? Or physical gold? How about mutual funds? Or do you buy directly into the equity markets? Knowing the mathematical blueprint is useless if you don't have an execution strategy. In the next season, we are closing that gap by breaking down the absolute basics of where to put your money.
लाइक शेयर सब्सक्राइब कर दो यार।